As we look ahead to the Fed, it's clearly going to be on the mind of investors in the US, and the way that Jay Powell and team communicate about inflation, of course, front and center. What is the data, though, now in the US telling us about the reflation of that economy and potential risks around inflation shocks?
Right. We really have to distinguish between sustained inflation versus raising prices, which, given the kinks and surges coming out of lockdowns and the pandemic policies, isn't unexpected. And in fact, it's the market mechanism doing what it's supposed to do when we see those sorts of supply challenges. Inflation, the kind that we'd worry about, the kind that the Fed would react to, is sustained and broad and really driven by the amount of money chasing real goods and services for no good reason, so to speak, versus what we see today, which has distinct reasons behind it.
When it comes to the question of growth in the US, we have the GDP print out towards the end of the week. At what point and at what level of growth do you have to see before the position of the Fed around QE and not unwinding and not stopping that QE program becomes untenable? We saw, of course, the Canadian Central Bank mapping out its plans to shrink its balance sheet. When will the Fed be forced to act?
Well, we haven't seen a lot of appetite so far, at least in the dialogue, for putting on the brakes too soon. And of course, we can look to China and see it's the tremendous numbers it printed on the back of dreadful numbers last year. The U.S. will be in a similar position. I don't think we're close to seeing real meaningful movements in interest rates over probably another 12-month period. That said, beyond that, if we start to see this sustained inflation, I think the last time we really have a good benchmark for that, if you look at the 1960s, for example, in the early half of that decade, inflation averaged about 1% growth per annum. By the end of that, by the back half of the decade, it rose to about 6%. That's the kind of inflation number that really begins to make people nervous. And of course, there's always the concern that we wait too long. Nobody wants to repeat the sort of 70s inflation that we saw.
And Karen, I mean, the question, to your point, the question of raising prices from a corporate perspective is almost the same question as, do I hire more people? Do I commit more capex? Do I commit more fixed costs moving forward? I mean, you guys speak to a lot of corporates out there. Can you give us a little bit of an indication where corporate confidence is at this point in time on the ground in the U.S.?
People, most of the companies that we see a real sustained recovery. Obviously, there are challenges. We've seen massive price spikes in lumber, for example, real volatility there, in resins, which we've looked into quite a bit. All of those price spikes and price unpredictability will make it very hard for planning. But that said, we have to be able to see beyond that to the longer term forecast. And we see a lot of confidence that in the industries that were impacted by the lockdown and by the other policies to suppress the virus, that there is real recovery. Some slower than others. Clearly, airlines are dragging more than they'd like, but most of the businesses that we see are seeing a sustained recovery in the U.S., certainly at this point. Europe is a little bit more challenging because they've come in and out of their own suppression policies because of fighting waves of the virus.
Karen, I know you guys have some research on employment. Over the weekend, I was just walking here in Hong Kong. Some of these bars, you have people, not really a lot of people in the bars themselves. You have the waiters, you have the bartenders, they're all there, but they're not really doing anything. I guess my point is people might be employed, but the activity isn't there. I know you have some data on this. Could you tell us a little bit more about these workforce challenges that you guys are seeing?
I think what we worry about most when you think about what will stick coming out of the pandemic was the appetite for human-to-human interaction dropped quite a bit, of course, during the peak of the virus. And during that time, many companies innovated and found ways to digitize interactions, from the surge of people picking up banking online who otherwise had resisted before, to self-checkouts in stores. All of that creates displacement of jobs and a greater comfort level with the lack of a human being interacting the way most of us who were traveling before the pandemic were comfortable going through most of the airport before security without ever interacting with a human being. As that accelerates across multiple sectors, there's a real possibility that we see displacement. Now, in the kinds of services you're talking about, you can imagine that there is some need for servers to create atmosphere, but do you really need someone as a cashier when that person in many places in the world already checks people out on a tablet and so forth? And I think that persistent job loss due to automation accelerated by the pandemic is what really concerns us.
And Karen, we talked about the geopolitics, the fact that the US corporate sector here, or that has a footprint here in China, has been asked by the Chinese government to push for a removal of tariffs. It seems fanciful to some, at least. Talk to us about the supply chain changes in the US and China driven by their own domestic economic plans, and how your clients are adjusting to that reality.
Right. Well, we can't unsee the supply chain shocks that happened during the pandemic, first with the shutdown of Wuhan and China more broadly as the pandemic rolled through there, and then in other parts of the world. And the level of mistrust around the handling has really created what is likely to be an unraveling of U.S.-China relations that will persist. If you look at the stated policies of both China and the U.S., dual circulation, which does involve creating more self-sufficiency in critical industries while still engaging in trade, and build back better in the U.S., all of that points towards greater focus on building up domestic capacity. And I would just say, when countries are writing $1 trillion worth of checks, the pressure is going to be on to invest that at home. So regardless of the intervention or will of companies operating in both markets, I think it will be really challenging to reverse that train of at least disengagement and more focus on domestic markets where possible for many companies.